6 months ago, someone watching a video exactly like this one decided to actually follow through. They didn't have any special advantages, no windfall inheritance, no surprise promotion, no lottery ticket. They just committed to a systematic approach and stuck with it. Today, that person has eliminated their credit card debt, built a four-figure emergency fund, started investing automatically every month, and for the first time in their adult life, they actually know where their money goes. That transformation didn't require earning more money. It required changing their relationship with the money they already had. Meanwhile, someone else watched the same video, nodded along, thought it sounded reasonable, and then did absolutely nothing. 6 months later, their financial situation is identical or worse. Same debts, same paycheck-to-paycheck stress, same vague anxiety about money that never quite goes away. The difference between those two people isn't intelligence or income or luck, it is execution. The first person treated the information as a blueprint and followed it. The second person treated it as entertainment and moved on. This video is a complete 6-month blueprint for transforming your finances. Not vague advice about spending less and saving more. An actual month-by-month system with specific actions, concrete targets, and measurable outcomes. By the end of month 6, you will have a functioning financial infrastructure that builds wealth automatically, protects you from emergencies, and aligns your money with what you actually care about. But I need to be honest with you up front. None of this works unless you actually do it. The information itself is worthless. Execution is everything. If you can commit to following this system for 6 months, really following it, not just thinking about it, you will be in a fundamentally different financial position than you are today. Let's get started with month 1. Month 1 is about building the foundation, and the foundation starts with brutal honesty about where you currently stand. Most people have only a vague sense of their financial reality. They know roughly what they earn, have a general idea of their major expenses, and feel varying degrees of anxiety about whether they're doing okay. This vagueness is the enemy. You cannot fix what you cannot measure, and you cannot measure what you refuse to examine closely. Think of your personal finances like a business. Every successful company knows exactly what comes in and what goes out. A McDonald's franchise tracks revenue, expenses, and profit margins daily. They know which menu items generate the highest margins and which ones underperform. They make decisions based on data, not feelings. Your financial life deserves the same rigor. You need to become the CEO of your own money. The first action in month 1 is a complete financial audit. Pull up the last 3 months of statements from every account where money flows. Checking accounts, credit cards, Venmo, PayPal, any subscription services. Open them all in separate tabs on your computer so you can see everything at once. Now categorize every single expense into 3 buckets. The first bucket is fixed expenses. Money you have to spend every month to function. Rent or mortgage, utilities, car payments, insurance, groceries, transportation, subscriptions you genuinely use. These are your non-negotiables. The second bucket is discretionary expenses. Money you choose to spend on things you want but don't technically need. Restaurants, entertainment, shopping, travel, that third streaming service you barely watch. These aren't bad expenses, but they're optional. The third bucket is debt payments. Student loans, credit cards, car loans, personal loans, anything you're paying back. Write down the average monthly spend in each category. Then add up your total monthly expenses and compare that to your monthly take-home income. Not your gross salary, your actual after-tax income that hits your bank account. The difference between income and expenses is your current savings rate. If you're spending more than you earn, that's a negative savings rate, which means you're going backwards financially every single month. If you're saving 10%, that's decent but improvable. If you're saving 20% or more, you're in strong territory. This exercise will reveal truths you might not want to see. Maybe you're spending $400 a month on food delivery without realizing it. Maybe your subscriptions total $200 when you thought they were closer to $50. Maybe you're spending more on your car than on your retirement. These insights aren't meant to shame you. They're meant to give you the information you need to make different choices. You cannot optimize what you don't understand. While you're auditing your spending, take one immediate action that puts money in your pocket. Make sure you're capturing any free money available to you. If your employer offers a 401k match and you're not contributing enough to get the full match, you're literally leaving free money on the table. An employer match is an immediate 100% return on your investment. There's no investment in the world that reliably offers that. In 2026, you can contribute up to $2,400 to a 401k. And if you're 50 or older, you can contribute an additional $8,000 in catch-up contributions for a total of $3,500. If you're between 60 and 63, you can contribute up to $35,650 thanks to the enhanced catch-up provisions. For IRAs, the limit is $7,500 with an additional $1,100 catch-up contribution if you're 50 or older. You don't need to max these out in month one, but you do need to ensure you're at least contributing enough to capture any employer match. If your employer matches up to 6%, make sure you're contributing at least 6%. That match is part of your compensation. Don't leave it behind. The final component of month one is establishing a weekly financial check-in. Pick a specific time, maybe Sunday evening or Monday morning, and spend 10 to 15 minutes reviewing your accounts. Look at what you spent in the past week. Compare it to your budget. Notice any patterns or surprises. This weekly rhythm keeps finances at the front of your mind without becoming obsessive. Most people either ignore their money completely or check their accounts anxiously multiple times per day. Neither extreme is healthy. A weekly check-in strikes the right balance. Engage but not consume. By the end of month one, you should know exactly how much you earn, exactly where your money goes, what your current savings rate is, and whether you're capturing any available employer match. You've built awareness. Now it's time to cut the fat. Month two is about reducing expenses and redirecting that money toward your goals. Take your categorized expenses from month one and sort them from largest to smallest. The biggest expenses offer the biggest potential savings, but they're also often the hardest to change. Rent is probably your largest expense, but you can't easily reduce it mid-lease. Your car payment might be significant, but you're locked into that loan. That's fine. Start with the expenses you can actually control. Look at your discretionary spending categories. Where are you spending money that doesn't align with what you actually care about? Maybe you're spending $300 a month eating out, but you don't even particularly enjoy restaurants. It's just convenient. Maybe you're paying for a gym membership you haven't used in 6 months. Maybe you have subscriptions to services you forgot existed. Go through your subscriptions systematically. Cancel anything you don't actively use. Negotiate lower rates on the services you do use. Call retention departments and mention you're considering canceling. Many companies will offer discounts to keep your business. For variable expenses like food delivery, shopping, and entertainment, set specific monthly limits based on your values, not arbitrary restrictions. If travel is genuinely important to you, don't slash that budget to zero. Instead, cut ruthlessly from categories you don't care about to fund the ones you do. The goal isn't deprivation. The goal is intentionality. Spend extravagantly on things that genuinely matter to you and cut mercilessly on things that don't. One area where most people leave significant money on the table is insurance. When was the last time you shopped for car insurance, home, or renter's insurance? Most people set these up once and never revisit them, but rates vary dramatically between providers. Getting quotes from 3 or 4 companies takes maybe an hour and could save you hundreds of dollars annually. Your target for month 2 is to identify expenses you can reduce by at least 10 to 15%. If you're currently spending $4,500 per month, finding $500 to $700 in savings is realistic for most people. That money doesn't disappear. It gets redirected toward building your financial foundation. Also, in month 2, face your debt honestly. Pull your credit reports from all 3 bureaus. You can get them free once per year at annualcreditreport.com. Look at every debt you owe: credit cards, student loans, car loans, personal loans. Write down the balance, interest rate, and minimum payment for each. The average credit card interest rate in 2026 is over 21%. At that rate, debt compounds against you brutally. A $6,000 credit card balance with a 21% APR paid at the minimum takes over 7 years to pay off and costs you roughly $3,600 in interest, more than half the original balance. Call your credit card companies and ask for a lower interest rate. This sounds intimidating, but it works more often than you'd expect. Say something like, "I've been a customer for several years, and I always pay on time. I noticed other cards are offering lower rates, and I wanted to ask if you could reduce my rate." The worst they can say is no. The best case is they drop your rate several percentage points, which saves you hundreds of dollars over time. By the end of month 2, you should have reduced your monthly expenses meaningfully and have a complete picture of your debt situation. You've stopped the bleeding. Now it's time to build your safety net. Month 3 focuses on building an emergency fund and protecting yourself from financial shocks. Here's a statistic that should alarm you. 48% of Americans cannot cover a $1,000 emergency expense with their savings. 24% have no emergency savings at all. This means nearly half the country is one car repair, one medical bill, one broken appliance away from financial crisis. When you don't have an emergency fund, every unexpected expense becomes a debt event. Your transmission fails and you put it on a credit card at 21% interest. Your kid needs urgent dental work and you take out a personal loan. Each emergency pushes you further into debt, which creates more financial stress, which makes it harder to build savings, which leaves you vulnerable to the next emergency. It's a vicious cycle that traps millions of people. Your first target is $1,000 in dedicated emergency savings. This isn't a magic number, but it's a psychological threshold that matters. Having 4 figures in your emergency fund feels fundamentally different from having 3. It provides a buffer against most common emergencies and gives you breathing room. If $1,000 feels impossible, start smaller. Even $500 is better than nothing. Even $200 is better than nothing. The goal is to break the cycle of living without any cushion at all. To build this fund quickly, redirect the savings you identified in month 2. If you cut $400 per month in expenses, that's $400 per month toward your emergency fund. In 3 months, you'll have around $200. You can accelerate this by generating additional income. Sell things you don't use. Old electronics, clothes, furniture, equipment. Most households have hundreds or even thousands of dollars worth of unused items collecting dust. Convert that stuff into cash and put it in your emergency fund. You can also take on temporary side income, freelance work, delivery driving, dog walking, selling skills on platforms like Fiverr or Upwork. The income doesn't need to be permanent. You're sprinting to build your initial safety net. Where you keep your emergency fund matters. Open a high-yield savings account at an online bank and keep it separate from your regular checking account. In 2026, the best high-yield savings accounts pay 4% or more in annual interest compared to the national average of 0.39% at traditional banks. On $5,000, that's the difference between earning $200 per year and earning $20 per year. The separation also matters psychologically. When your emergency fund is in a different bank, you don't see it every time you check your balance. You're less tempted to borrow from it for non-emergencies. It's there when you need it and invisible when you don't. Also, in month 3, continue aggressively paying down any high-interest debt. Choose a payoff strategy and commit to it. The debt avalanche method prioritizes debts by interest rate. You pay minimums on everything and throw extra money at the highest rate debt first. This mathematically minimizes total interest paid. The debt snowball method prioritizes debts by balance size. You pay off the smallest debt first, then the next smallest, regardless of interest rates. This generates psychological wins more quickly, which keeps some people motivated. Either method works. What matters is choosing one and sticking with it consistently. Every dollar you put toward high-interest debt is effectively an investment earning whatever that interest rate is. Paying off a credit card at 21% is equivalent to earning 21% on an investment, better than almost any other return available. By the end of month 3, you should have at least $1,000 in a dedicated emergency fund, a clear debt payoff strategy in motion, and continued momentum on expense reduction. The foundation is solid. Now it's time to build wealth. Month 4 shifts focus to investing in automation. Here's the truth about wealth building that most people don't understand. It's not about finding the perfect investment or timing the market or discovering some secret the wealthy keep hidden. It's about putting money into appreciating assets consistently over long periods of time and letting compound growth do the work. The S&P 500 has averaged roughly 10% annual returns over the past century. That includes the Great Depression, the 2008 financial crisis, the 2020 pandemic crash, and every other disaster you can imagine. Over any 20-year period in history, the stock market has produced positive returns. Over any 30-year period, the results have been strongly positive. This doesn't mean you'll earn 10% every year. Some years you'll earn 25% like 2024 and 2023. Some years you'll lose 18% like 2022. The average smooths out over time, but the experience is volatile year to year. The key is staying invested through the volatility. People who panic and sell during downturns lock in their losses. People who stay invested through downturns eventually recover and continue growing. Time in the market beats timing the market every single time. For most people, the simplest and most effective investment strategy is a low-cost index fund that tracks the S&P 500 or the total stock market. You can buy these through any major brokerage. Vanguard, Fidelity, Schwab with expense ratios under 0.10%. That means for every $10,000 invested, you're paying less than $10 per year in fees. You don't need to pick individual stocks. You don't need to follow financial news. You don't need to guess which companies will outperform. You just buy the index and let the entire market work for you. If you want even more simplicity, consider target date funds. These are all-in-one funds that automatically adjust your asset allocation as you age. You pick the fund with the year closest to when you plan to retire, like Vanguard Target Retirement 2050, and the fund handles everything. It starts more aggressive when you're young and gradually becomes more conservative as you approach retirement. Set it and forget it. The magic of month 4 is automation. You're going to set up a system where money flows automatically from your paycheck to your financial goals without requiring any action from you. Here's how the automation works. When your paycheck hits your checking account, automatic transfers immediately move preset percentages to different destinations. Maybe 5% goes to your 401k before you even see it. Another 5% transfers automatically to your Roth IRA or brokerage account. 3% goes to your high-yield savings account. 2% goes to a separate savings account for specific goals like travel or a car down payment. After all these automatic transfers, whatever remains in your checking account is yours to spend guilt-free. You've already paid yourself first. You've already funded your future. The money left over is genuinely available for current expenses without any mental calculations about whether you're saving enough. This system removes willpower from the equation. You don't have to decide each month whether to invest. You don't have to resist the temptation to spend money that should go towards savings. The decisions happen automatically based on rules you set once. Set up automatic bill payments for everything possible. Rent, utilities, insurance, subscriptions. Set up automatic credit card payments in full so you never pay interest and never miss a payment. The goal is a financial system that runs itself, requiring minimal intervention from you. By the end of month 4, you should have automated investments flowing to retirement accounts and/or a brokerage account, automated savings transfers to your emergency fund and goal-specific accounts, and automated bill payments, eliminating the possibility of missed payments or late fees. Your money is now on autopilot. Month 5 is about addressing the psychological dimension of money, the invisible scripts that sabotage your financial progress. Here's something most financial advice ignores. Your beliefs about money shape your behavior with money. If you believe you'll always be bad with finances, you'll never try to improve. If you believe rich people are inherently greedy, you'll unconsciously sabotage your own wealth building. If you believe you deserve to treat yourself after a hard day, you'll consistently overspend on things that don't actually make you happy. These beliefs, often called money scripts, are usually formed in childhood and operate below conscious awareness. You don't think about them. They just influence your decisions automatically. Take 10 minutes and write down everything that comes to mind when you think about money. No filtering, no judgment. What did your parents say about money? What did you learn about wealthy people? What do you believe about your own ability to build wealth? Some common limiting beliefs. Money is evil or rich people are greedy. This belief keeps you small, convincing you that building wealth would somehow make you a bad person. In reality, money is a tool. It amplifies who you already are. Generous people with money become more generous. Greedy people with money become more greedy. The money itself is neutral. I'll always be bad with money. This belief becomes a self-fulfilling prophecy. If you believe you're inherently bad with money, you won't learn the skills to get better. But managing money is just a skill like cooking or driving. Nobody is born knowing how to budget. Everybody can learn. I deserve to treat myself. This belief justifies overspending as self-care. The problem isn't treating yourself. It's using that justification to make purchases you can't afford on things that don't actually improve your life. True self-care is building financial security, not temporary consumption that creates long-term stress. Once you've identified your limiting beliefs, ask yourself, is this belief helping me or holding me back? If it's holding you back, consciously choose to replace it with a more empowering belief. Also, in month 5, if you have a partner, have a money conversation. Financial disagreements are one of the leading causes of relationship conflict, and yet most couples avoid talking about money until there's a crisis. Don't wait for the crisis. Schedule a 30-minute money date. Not in the heat of a disagreement, but calmly and intentionally. Start with something positive. Acknowledge something your partner does well with money. Then share your visions. What does a good financial life look like to each of you? What are your goals? What are your fears? Share your money scripts. What did you each learn about money growing up? Understanding your partner's financial psychology helps explain behaviors that might otherwise seem irrational. Maybe they grew up with scarcity and now hoard cash because savings feels like safety. Maybe they grew up with abundance and never learned to budget because money was always available. You don't need to agree on everything, but you need to understand each other and find common ground on big decisions. How much should you save? What are your joint priorities? How do you handle individual spending? End the conversation with one specific action you'll take together. Maybe setting up a joint savings account for a shared goal, or agreeing on a spending threshold above which you'll consult each other. Month 5 is also when you focus on increasing your income. You've spent 4 months optimizing your expenses, but there's a limit to how much you can cut. You can only reduce expenses to 0, and you still need to eat and have shelter. There's no limit to how much you can earn. The most straightforward path to higher income is negotiating a raise at your current job. Research market rates for your role using sites like Glassdoor, PayScale, and LinkedIn Salary Insights. Document your accomplishments and contributions. Then schedule a conversation with your manager. A script that works. I've been reflecting on my contributions over the past year. I've accomplished X, Y, and Z, which created value for the company in these specific ways. Based on my research on market rates for this role, I'd like to discuss adjusting my compensation to reflect my contributions. What can we do to make this happen? You might not get an immediate yes, but you've planted the seed. And if they say no entirely, that's valuable information. Maybe it's time to look elsewhere. If you can't negotiate more at your current job, consider whether a job change would significantly increase your earnings. People who change jobs strategically typically see larger salary increases than those who stay in place and wait for annual raises. You can also develop additional income streams, freelance your professional skills, start a side business, monetize a hobby or expertise. Even an extra $500 per month accelerates your financial progress dramatically. That's $6,000 per year toward debt payoff, emergency savings, or investments. By the end of month 5, you've confronted your psychological barriers to wealth, had productive money conversations with your partner, if applicable, and taken concrete steps to increase your income. The internal work is just as important as the external systems. Month 6 is about scaling up and setting yourself up for long-term success. By now, you have systems in place: automated investments, automated savings, a functioning budget, a growing emergency fund, debt payoff in progress, and hopefully increased income. Month 6 is about refining these systems and extending your time horizon. First, schedule your first monthly financial check-in. This is more thorough than your weekly reviews. Once a month, sit down for an hour and examine everything. How much did you earn? How much did you spend? Did your spending align with your priorities? How much did you invest? How much did you save? Did your net worth increase or decrease? Calculate your net worth by adding up all your assets, checking accounts, savings accounts, investment accounts, retirement accounts, home equity if you own property, and subtracting all your liabilities, credit card debt, student loans, car loans, mortgage. The resulting number is your net worth. Track this number monthly. Over time, watching your net worth grow becomes incredibly motivating. You can see concrete progress rather than just hoping things are improving. Even if the growth is slow at first, the trajectory matters. Are you moving in the right direction? Second, set longer-term goals now that you have the foundation in place. Your one-year goal might be to eliminate all credit card debt and have 3 months of expenses in your emergency fund. Your 5-year goal might be to have 6 months of expenses saved, be debt-free except your mortgage, and have $100,000 invested. Your 10-year goal might be to reach financial independence or make a major purchase without debt. Write these goals down. Research shows that people who write down their goals are significantly more likely to achieve them than people who just think about their goals. Writing forces specificity. Instead of save more money, you commit to have $50,000 invested by December 2031. Third, share your goals with someone who will hold you accountable. A partner, a friend, a family member, an online community. Public commitment increases follow-through. When you tell someone you're going to do something, you're more motivated to actually do it because now your reputation is on the line. Fourth, schedule quarterly reviews on your calendar right now. Every 3 months, take a longer view of your financial progress. Are you on track toward your annual goals? Do you need to adjust your approach? Have your circumstances changed in ways that require updating your plans? These quarterly reviews prevent drift. It's easy to let months go by without examining whether your systems are still working. The quarterly checkpoint catches problems before they compound. Finally, consider increasing your investment contributions. If you started at 5% in month 4 and you found additional money through expense reduction or income increases, bump it up. The goal is to gradually increase your savings rate over time until you're saving and investing 20% or more of your income. Every percentage point increase in your savings rate accelerates your path to financial independence. Someone saving 10% of their income might take 40 years to retire. Someone saving 20% might do it in 30 years. Someone saving 50% might retire in 15 years. The math is stark and unforgiving. Let me give you concrete numbers to illustrate what's possible. If you invest $500 per month starting today, earning the historical average of 10% annually, in 10 years, you'll have approximately $102,000. In 20 years, you'll have roughly $380,000. In 30 years, you'll have about $1.1 million. If you increase that to $1,000 per month, those numbers double. $240,000 in 10 years, $760,000 in 20 years, $2.2 million in 30 years. And if you can invest $2,500 per month, which is possible for many households if they eliminate debt and control lifestyle inflation, you're looking at $306,000 in 10 years, $9.14 million in 20 years, and $3.3 million in 30 years. These aren't fantasy numbers. They're mathematical reality for anyone who invests consistently over long periods. The challenge isn't understanding the math. It's executing the behavior consistently for decades. That's what the 6-month blueprint is designed to create. Behavior change that compounds over time. Here's what you've built over these 6 months. In month 1, you established awareness, knowing exactly where your money goes. In month 2, you cut expenses and faced your debt honestly. In month 3, you built an emergency fund and began aggressive debt payoff. In month 4, you automated investments and created a self-running financial system. In month 5, you addressed psychological barriers and worked on increasing income. In month 6, you established long-term goals and created systems for ongoing review and improvement. Each month builds on the previous ones. The person who completes this blueprint is fundamentally different from the person who started it. They have habits, systems, and knowledge that most people never develop. But I want to be clear about something. This blueprint doesn't end at month 6. It's the beginning of a lifelong relationship with your finances, not a one-time project you complete and forget. The wealthy didn't get wealthy through a single 6-month effort. They got wealthy through decades of consistent behavior, spending less than they earned, investing the difference, and letting compound growth work in their favor. The 6-month blueprint gives you the foundation and habits. What you do afterward determines your financial destiny. Some people will watch this video, feel inspired, and do nothing. They'll file it away as good advice I should follow someday and return to their existing patterns. In 6 months, they'll be exactly where they are now, or worse. Others will watch this video and actually execute. They'll pull up their bank statements tonight. They'll categorize their expenses this week. They'll set up automated transfers this month. They'll do the work even when it's uncomfortable, even when they don't feel like it. The difference between those two groups isn't intelligence or talent or luck. It's action. You can change your finances in 6 months. The question is whether you will start today, not tomorrow, not next week, not when things calm down, today. Pull up your bank statements. Calculate your savings rate. Make a list of subscriptions to cancel. Set up that high-yield savings account. Contribute enough to get your employer match. Small actions compound into massive results. The person you'll be in 6 months is determined by the actions you take today. If this blueprint has changed the way you look at your bank account and your future, please subscribe and like the channel. We are uncovering the financial truths that have been hidden in plain sight to help you build a life of freedom. Start investing in your future self today. The next chapter of your wealth building journey will begin soon.